Here are the Unit 4 notes on credits. In particular, we're going to talk about credit and if you are worthy of using credit. So first, let's just look at a couple of terms. First term is collateral. Collateral is property of value that lenders can take from you if you default on a loan. So some examples of collateral would be things like a car, a house, a horse, or anything that you have that would be worth significant value. Jewelry, for example, as well. And when we're looking at credit, we always look at 3 C's. Those 3 C's are your capital. That means your asset of value or money that can be taken and sold for cash to repay. So once again, kind of like collateral, like what is it that you have that's of worth? A house, a car, jewelry, things like that. Capacity, that is your ability to pay. So ability to pay back whatever it is that you borrowed on credit. So that's looking at your job and the income from your job. Your employment history in terms of how long you've been at a job, because a lot of times before someone grants you credit, they want to see that you've had some stability so they know that you'll continue to have that stability and be able to pay that credit back. Character, are you trustworthy? And how do they determine if you're trustworthy? They look at your credit history. Have you shown in the past that you've been able to pay things back in full and on time? Your character has a lot to do with whether new creditors are going to continue to grant you credit. So credit costs. There's a couple things that have to do with the overall cost of a loan. So how you determine the overall cost of credit? Let me actually pause right here and say that we'll use the term credit and loan pretty interchangeably as we go through this unit. So please understand that they both mean the same thing. Borrowing money to pay for something, that is credit and that is a loan. So how do you determine it? First of all, the length of the loan. Second would be the annual percentage rate, or the APR. So that just has to do with your interest, the amount of interest that you're going to be paying on the loan or on the credit. The amount of the loan, so that means like the amount that you have actually borrowed, and then fees, any other fees that you may pay on that loan, such as if there's a missed payment fee, or if there's a fee because you did not pay on time, things like that. So in class, we're going to actually complete a worksheet together to determine which loan would be cheapest, and you're going to be comparing every one of the above costs, because all those different costs, those 4 things, all determine the overall price of your loan, and those different costs or those different factors are going to make different impact on the overall cost of the loan. Your credit score is very important in terms of determining whether you're credit worthy. So it's typically called a FICO score, and the range for that credit score is between 300 and 850. 300 being the worst, 850 being the best. When it comes to doing something to hurt your credit score, it ranges from 80% delinquency to 1% delinquency. And all the scores that they have for your credit score are based on the number of accounts that you have, how long you've had the accounts, so the age of the accounts, the age of the youngest accounts, meaning the accounts that you've had for the least amount of time, any public record of bankruptcy or judgment that does go onto your credit history and reflects your credit score, and then your worst delinquency. So that whole 80% to 1% delinquency, that worst delinquency is always going to be the biggest impact on negatively affecting your credit score. Okay? And there's 3 main companies that report your credit scores to you. They're called credit bureaus. Those 3 credit bureaus are Equifax, Experian, and TransUnion. You all will see this on the test. You need to make sure you understand that those are the 3 credit bureaus: Equifax, Experian, and TransUnion. And in order to get information about your credit score, the most reliable one to use is annual excuse me, annualcreditreport.com. They do give you a free credit report. You can pull a credit report from each of the credit bureaus one time within the course of a year for free. So a lot of times people will space it out, like they will maybe pull their Equifax return in January, and then a couple months later in April they'll pull their Experian, and then a couple months later, like in August, they'll pull their TransUnion, and then maybe begin again in January with pulling that Equifax again. You can pay to get your credit score through other companies. Just have to be careful about the cost that's involved in it. And then too, a lot of times credit card companies, as a part of like their package, when you get your bill in the mail, they may send you your credit score every month as well. And keep in mind that credit scores can change from day to day, just depending on what you did or what's going on or what have you. Sometimes even change throughout the day. And we're going to look at some credit report information in class in regards to these things. I encourage you to go to the PowerPoint itself and click the link to look at that credit report information. Alright, so different types of loans. First type is a secured loan, and that is a loan that has property to back it up. Secure means safe. So in other words, if you had something that's under a secured loan, like a house is a secured loan or a home is a secured loan, if something were to happen where you weren't able to pay back that loan in full, then they would be taking that house or taking that car that you are borrowing money on. Typically, loans that are secured loans, typically the interest is lower than if it was an unsecured loan. An unsecured loan has no property to back it up. And so the interest rates typically are larger. So a student loan is a good example of an unsecured loan, or cash loans. Cash loans typically would mean like your credit card, things like that. That would be a cash loan. Usually more expensive, like I said, because of that higher interest rate. Okay. If you don't pay, let me go back, I'm sorry. So if you don't pay these loans, remember the banks can garnish your wages. Garnish your wages means calling your employer up, telling them, hey, this person owes me money. Before you give them their paycheck, will you please send us X amount of dollars until they pay off this loan, and that does happen. Your wages can be garnished. So how do you get credit? It's a good question. One thing that you can do, and I'm sure a lot of you want to know how you can get credit, right? You can open a checking or savings account, and keeping that account maintained is a good sign for creditors in terms of you being ready to use credit appropriately. So making sure you're managing those accounts like I just said. Paying any bills that you have on time, because not all bills are related to credit card bills. So whatever bill you may have, whether it be like an insurance bill or cable bill, utilities, things like that, those all show proof that you are worthy of credit as well. Now, by law, if you are under the age of 21, you do have to have a cosigner on any type of credit card. And a cosigner, the thing about it is that they take on whatever credit history you have, you now share with whoever your cosigner is. So you do want to be careful about making this decision to cosign with someone else, especially if you know that their credit is not good. Because if they by chance don't pay that back, you do become responsible for that. Prepaid credit cards, also a really good way to get you practicing how to manage a credit card, same way that a checking or savings account will help you with that. And then be choosy. Make sure you do your research. A couple good websites to use to research credit cards would be creditcard.com and then also bankrate.com. Other really good idea is, instead of starting out with like a cash credit card that you can use anywhere, open a single retail source credit card. So maybe a gas card is a good idea because you're not going to ball out on gas typically. A department store, etc. Avoid one that you can use anywhere until you are trained how to successfully use one. So gas cards are really good because you're only using them on gas. So you go fill up your gas tank like you would anyway, and you would pay that card off in cash as soon as that that amount processes on your card. So then you have that routine of paying that credit off in full from month to month or from whatever, and that shows that you are worthy of handling credit appropriately. Bankruptcy. Ugh, scary word. Bankruptcy is the last result of if you have not been paying your credit or paying whoever you owe back on time or in a timely manner. Bankruptcy is your last option. Reason why you want to use bankruptcy last is because if you file bankruptcy, it stays on your credit report for 10 years. There's two causes of having to file bankruptcy: unavoidable misfortune or careless, irresponsible use of credit. And there's two types. Chapter 7. Chapter 7 erases most of your debt. To qualify, you must be unemployed or have a very low income, and you may lose possessions if you file Chapter 7. Or Chapter 13, and if it's Chapter 13, you repay many of your debts under the supervision of the court. So there's two different bankruptcies, Chapter 7, Chapter 13. Alright, once again, I encourage you to actually go to the actual PowerPoint on Google Classroom to take a look at these credit card statements and the different parts of them, and and all of that. But we'll also talk about and look at these in class. Alright, so now you want to apply for a credit card. Well, you need to go through the application process. Things you would need to have is your social security number. Also your driver's license number if you have one. Your date of birth. Your employer, because it will ask you for your employer. They want to see that you're employed to trust you that you're going to pay your money back that you borrowed. Your income also needs to be reported. Sometimes that's what they use to base off your credit limit. Other debts that you have, so any other lines of credit, things like that, or money that you owe on those lines of credit. If you pay a mortgage or if you're renting, how much you're paying for those things, because typically those are your biggest expense. They may also want to know banking information and accounts, because they'll check that too. And then any references that you may have in terms of showing that you're credit worthy. So we're going to look, like I said, there's a link here for application. I encourage you to take a look at the PowerPoint yourself to look at that link for that credit card application. And then 2, take a look at the sample credit report within the actual PowerPoint link for this. And then we're also going to talk about the daily minimum payment in class. Once again, I encourage you to take a look at this from the actual PowerPoint that will be on Google Classroom, or Google Slides, I should say. So now, the big question is evaluating your worthiness. Do you feel like you are credit worthy? Why or why not? Complete your personal evaluation. Provide evidence of why you evaluated yourself as you do. Are you ready right now to use credit? Do you feel that you can handle it? Do you meet all of the criteria that is used when you determine if you are going to be someone that can be trusted to use credit, right? Because credit is borrowing money from someone. So if you're making that decision to borrow money from someone, that person is going to want to make sure that you can pay it back, or that company is going to want to make sure that you can pay it back. So are you now currently at a point where you are worthy of allowing someone to let you borrow money?